Welcome, G-Traders. You're watching a recap of the Asian trade on June 23. Yesterday, several central banks announced their key rate decisions, which impacted market sentiment. The Bank of England and Swiss National Bank raised the key rates more than expected. It adversely affected stock markets. Asian stock indexes declined in the morning as well. Most stock indexes are likely to end the week in the red due to the hawkish rhetoric of the top central banks, especially the Fed. Yesterday, during his second speech before a House committee, Jerome Powell confirmed the regulator's plans to hike rates further. He said that inflation pressures continue to run high, and there is a long way to go to get inflation down to 2%. However, the economy is slowing down as the consumer prices and the rates remain high. It may also lead to a recession, and this is why optimism in the stock markets is waning. Movements on a Forex can hardly be called logical following such hawkish comments. Usually, currencies rise amid expectations of new rate hikes. However, investors flocked back to the safe haven assets due to the recession fears. It was extremely bullish for the greenback. It asserted strength versus its main rivals amid market uncertainty. It approached an intraday high of 102.70 in the Asian session, and it also grew to a new high of 102.90. Apart from that, initial jobless claims have been rising for the fourth straight week. It indicates a decline in the labor market and may be one of the signs of the imminent recession. The US currency retained its bullish bias, moving in the upward range of 102.30 and 102.70. While central banks are trying to tame inflation by hiking rates, consumer prices in Japan fell because of an ultra-loose stance. Inflation unexpectedly dropped to 3.2% in May, and this reading exceeded market expectations. After hitting a 3-month high of 3.5% in April, the forecast reading was 4.1%. At the same time, core inflation also declined to 3.2% in May from a 3-month peak of 3.4% locked in April. Consumer prices remain above the Bank of Japan's 2% target for the 14th consecutive months. A weak yen significantly undermines the standard of living. Apart from curbing inflation, the central bank's main priority is to raise wages. Therefore, a fall in May is a controversial factor for the yen. However, a tumble in the manufacturing and services PMI indexes in June could have more serious consequences. The weakening economy may force the regulator to revise its monetary policy settings. Perhaps the market reaction to this data triggered a sharp rise in the yen. There is also a chance that the central bank again intervened in the foreign exchange market. Policymakers noted that they were closely monitoring currency movements and would intervene if necessary. As the yen's trajectory is very similar to the one at the end of last year, it's very likely that intervention took place. In the morning, the yen dropped sharply to 142.80, moving in the price corridor of 142.70 and 143.50. The Australian dollar also dipped at the end of the week. In the Asian session, it went below the level of 0.67. It lacks all the drivers that usually boost its price. Fears about new rate hikes by central banks, rising inflation, and a possible recession took the shine off risk assets. Oil prices have not recovered after a sharp drop on Thursday. The Aussie, as a risk barometer and as a commodity currency, faced a double whammy day. At the end of the Asian trading, the AUD USD pair was trading in the downward range of 0.6686 and 0.6770. The New Zealand dollar also lost steam, trading in the red price corridor of 0.6129 and 0.6192. Its weekly decline totaled more than 1%. After rising for several consecutive sessions, the Kiwi retreated due to the pressure of a strong US dollar. What's more, fresh macro stats showed that the New Zealand economy slid into a technical recession. In the Asian session, the Kiwi sank to 0.6130. It's likely to remain in the bearish channel. And that's all for now. We hope your trades are profitable at the end of the week. Don't miss our next video review, and see you soon!